You are listening to the Vocal Technologist. Spoken tech for your ears.
I was actually just walking into the studio and had this completely random thought about secrets.
Oh, yeah.
Yeah, I just reckon it is genuinely impossible to keep one anymore.
Look, you are probably right about that.
Between social media and screenshots and everyone just loving the sound of their own voice, absolutely everything gets out eventually.
That is painfully true. Privacy feels like a concept from a completely bygone era.
It really does. But here's the thing. It feels so different when you are just a regular person versus when you are running a massive company.
Oh, straight up.
Like, think about that distinct feeling you get at the end of the work week, the whole Friday vibe.
Right.
If you are an employee, Friday is the finish line. It is that big exhaling breath.
You clock off and switch off.
Exactly. But if you are a founder, it is usually just the start of a weekend full of panic attacks and massive strategy sessions.
That is a very vivid and a very accurate way to put it, actually.
Because the clock never stops ticking.
It never stops ticking when it's your ship.
Yeah.
The silence of the weekend is actually way louder than the chatter of the work week when you are the one responsible for the payroll.
I reckon that is spot on. And speaking of silence, or I guess the lack of it, that is exactly what we are getting into.
We have got a lot to unpack.
We really do. We are looking at how the absolute biggest secrets and the biggest power moves are happening right now in the financial world.
The mechanics of modern money are literally being rewritten.
They are. Money is moving in ways that completely defy the old textbooks. So welcome to the Vocal Technologist.
It is great to be here to explore all this.
I am thrilled to have you with us as we unpack everything. We have got a massive agenda. We are going to look at the huge shift from public to private markets.
Which is frankly a monumental shift.
Huge. Plus, we are going to talk about AI agents that are literally writing their own code.
Equal parts fascinating and terrifying.
And we are going to get into how the lines between crypto and traditional banking are just getting incredibly blurry.
It is going to be a very comprehensive look at the actual plumbing of the future economy.
So let us get right into it. Let us unpack this private market power play.
Right.
Because there is this really interesting trend emerging where these massive tech companies are basically flat out refusing to ring the opening bell.
They're just entirely skipping the IPO process.
Yeah, they're just not interested.
And look, this is something David George from his 16s has been very vocal about recently.
Yeah, he has.
Because the traditional path always used to be that you build a company, you grow it, and then you IPO to raise capital.
That was the ultimate goal.
Right. It gives your early employees a way to cash out. That was the dream for everyone involved.
The classic exit strategy. You get to ring the bell on Wall Street, buy a big boat, and retire.
But now, not so much.
Not at all.
David points out that private capital markets are now just so incredibly deep and liquid.
So deep.
Companies like OpenAI or SpaceX simply feel zero urgency to ever go public.
Because they just do not need the public markets to raise funds anymore.
Exactly. They can raise billions and billions privately.
Yeah.
And perhaps more importantly, they can provide liquidity to their employees without taking on all the headache of public scrutiny.
No quarterly earnings calls.
No random analysts tearing apart your long-term strategy.
That really is the dream, is it not? Staying private means you do not have thousands of random shareholders breathing down your neck every 3 months, asking why growth slowed by 1%.
Precisely. And the numbers really back this up if you take a look.
What are we looking at?
Well, if you look at the figures from McKinsey, global private equity deal value hit $2.6 trillion in 2025.
2.6 trillion.
Yes. It is a staggering amount of money moving completely outside the public eye.
That is just heaps of zeros. It is the second highest level on record, I believe.
Spot on. It really proves that the main action is not on the stock market ticker anymore.
It is all happening in these quiet, private boardrooms.
Exactly.
But here's the twist, and I actually love this part. Robinhood is trying to crash this exclusive party.
This is a very clever move by Robinhood. Very strategic.
So what exactly are they doing?
They are planning to launch a $1 billion IPO, but not for their main retail trading business.
Okay.
It is entirely for their corporate venture capital fund.
Right. So let me get this straight. They are taking their venture fund public.
Yes. The whole idea is to democratize this exclusivity we were just talking about.
Ah.
Because usually to invest in high-growth companies like Databricks or Ramp or Stripe, you need to be an accredited investor.
You need a very high net worth.
Exactly. You need the net worth and you need the connections to even get in the room.
Right?
So Robinhood is essentially saying, We will put all these exclusive venture investments into a single fund, list that fund on the New York Stock Exchange, and let everyday retail investors buy shares in it.
That is actually brilliant.
It is a massive workaround.
So instead of buying shares in just Robinhood, the app, you are buying a slice of a portfolio that holds these private giants.
You're getting exposure you could never get otherwise.
It is wrapping exclusive venture exposure in a tradable stock.
It solves the access problem for regular people straight up.
And it solves the liquidity problem for the venture fund, too.
Exactly. It allows everyday investors to finally get a piece of the action well before these companies ever go public, assuming they ever even do.
I can see that being incredibly popular. Everyone wants to be able to say they own a piece of Stripe or SpaceX.
Oh, absolutely.
And speaking of Stripe, that brings us super neatly to our next topic, the consolidation of the giants.
This is where things get really interesting.
Because there is a massive rumor floating around that has got absolutely everyone talking.
You are referring to the whispers about Stripe and PayPal, of course?
I am indeed. The word on the street is that Stripe is seriously weighing a potential acquisition of PayPal, or at least parts of their business.
It is a truly fascinating potential development.
It is wild.
And if you think about the history here, it is just dripping with irony.
Oh, heaps of irony. PayPal used to be the absolute titan of online payments.
They were the original disruptor.
They were everything.
But now they are grappling with slowing volume, they are missing earnings, and they are facing incredibly intense competition from Apple Pay and Google Pay.
And meanwhile, Stripe is just ascending to the moon.
Stripe is currently valued at $159 billion.
That is massive.
They have essentially become the core infrastructure of the entire internet economy.
Yeah, they run everything behind the scenes.
So if this deal happens, or honestly, even if it is just being considered at the board level, it signals a completely new era of scale-driven power plays.
It really does. It is not just about pure innovation anymore.
No, it is about empire building. It is about total consolidation.
It is like the old guard being completely swallowed by the new guard.
Precisely.
But PayPal is not the only giant trying to figure out their place in this new world. Let us look at Klarna.
Ah, yes, Klarna.
They are globally known for buy now, pay later, but they are pivoting really hard right now.
They are aggressively chasing banking customers and debit cards.
Right.
Because they are realizing that buy now, pay later is essentially a feature, not necessarily a standalone business model that can sustain them forever.
Especially not with their mounting losses.
Exactly. They need to become a fully fledged bank.
I saw a really interesting quote from their CEO, Sebastian Siemiatkowski.
What did he say?
He was basically arguing that surging loan originations hurt their margins right now, but they drive massive lifetime profits later.
All right.
So they are well and truly playing the long game.
That is the big bet. They're willing to take the hit on their margins today to capture the customer for the next 20 years.
Yeah.
They want to turn those users who just click Klarna at the checkout into everyday banking customers.
It is a risky strategy.
Very risky.
Yeah.
But in this current environment, you literally have to evolve or you die.
Evolve or die. That feels like the perfect segue to get into the technology side of things.
I agree.
Because if you are not evolving with AI right now, you are definitely in a lot of trouble. So let us unpack the claw economy.
I absolutely love this term, the claw economy and the space-apocalypse.
It sounds like a terrible sci-fi movie, but it is actually our reality now.
It really is happening. The whole concept is that we are rapidly moving away from buying software products.
Right, like traditional software as a service.
Exactly. We are moving away from SaaS and moving towards hiring AI agents, or claws, that possess these modular skills.
So instead of paying a monthly sub for a seat on a platform, you are just paying for an AI agent to do a specific job.
That is it.
And Stripe, yet again, is right at the forefront of this. They have these things they call minions.
Stripe minions are a perfect example of this massive shift.
What exactly are they doing?
Well, they are unattended coding agents. And when I say unattended, I genuinely mean they are working completely on their own.
Without human supervision.
Right. They're producing over 1,300 merged pull requests every single week.
1,300 merged pull requests a week. That is an insane volume of work.
It really is.
That is not just a little helper bot. That is an entire full-scale engineering team.
It is. And the actual mechanics of how it works is fascinating.
How so?
They use this thing called a toolshed server. The agents run inside these isolated cloud boxes.
Okay.
They are given a task. They have access to a massive library of tools, and they just go and do it.
Oh.
They write the code, they fix the bugs, they run all the testing suites. They are not just assisting The human engineers, they're literally doing the work from start to finish.
That is wild to think about. But here is the part that actually blew my mind the most.
What is that?
You would logically think that all this cutting-edge AI requires brand new, ultra-shiny infrastructure to run on.
Right. That is the assumption.
But it turns out the old legacy finance systems are actually completely perfect for this.
It is honestly one of the great ironies of this current technological wave.
It really is.
We have spent decades complaining about big banks running on COBOL and flat files and these ancient mainframe systems from the 70s.
Everyone thought we had to rip it all out and replace it.
The whole digital transformation nightmare.
Exactly. It has cost billions.
But it turns out money primarily moves as structured text.
Right.
And AI agents are incredibly good at reading, writing, and parsing structured text.
Oh, wow.
So these AI agents can literally just wrap right around these ancient systems.
That is brilliant.
They can parse the COBOL, they can read the old flat files, and they can interact directly with the legacy infrastructure without anyone needing to rip a single thing out.
So the sheer laziness of banks refusing to upgrade their core systems has actually turned into accidental future-proofing.
In a very real way, yes.
That
Is accidental brilliance.
That is hilarious.
The extreme rigidity of those old systems makes them highly predictable, and AI absolutely thrives on predictability.
That makes perfect sense. So while the software engineers are panicking about the AI agents, the accountants are probably sweating next.
Oh, definitely.
We really need to talk about this startup called Basis, because they just hit a $1.15 billion valuation.
Basis is a prime example of AI rapidly moving up the value chain.
They are not just doing basic data entry either.
No, they're fully automating complex partnership tax returns.
And anyone who has ever had to deal with partnership tax knows that is absolutely not a fun or easy job.
It is incredibly complex and tedious.
Yeah.
But Basis is building AI agents that can handle all that nuance. And this is actually super critical because there is a massive shortage of accountants right now.
Right, so it is not just about cost cutting.
Exactly. It's not necessarily about replacing human workers. It is about filling a massive talent gap.
That makes sense.
It allows the human accountants to shift into strategic advisory roles where they can add real value to a business rather than just filling out forms all day.
And speaking of filling out forms, or rather the joy of not filling them out anymore,
Yes.
Experian has done something pretty cool with ChatGPT recently.
They have. They launched an insurance marketplace that sits directly inside ChatGPT.
So how does that work for the user?
Well, instead of going to a clunky website, typing in all your personal details, and filling out endless pages of forms just to get a basic quote, you just chat.
You literally just talk to the bot.
You just talk to it. You say, I need car insurance for my new sedan, and it asks you the relevant questions in a totally conversational way.
That is so much easier.
Then it instantly compares rates from 37 different carriers behind the scenes.
Wow.
It creates a user experience that completely bypasses the form-filling era of the internet.
I am so here for the end of the form-filling era. I absolutely hate forms.
We all do.
It just makes so much logical sense. Why would you want to navigate a terrible user interface when you can just use plain English to tell the computer what you want?
It is the natural progression of things. Interfaces are slowly becoming invisible.
Spot on. Now let us shift gears to another area where lines are seriously blurring right now.
Crypto and Wall Street.
Exactly. Because it really used to be that these were two entirely different universes.
Wow.
You had your traditional guys in suits on Wall Street, and you had your developers in hoodies in the crypto world.
Never the twain shall meet.
But now, they're essentially becoming the exact same thing.
The convergence is accelerating so fast.
Also at Coinbase.
Right. They are the biggest crypto exchange in the U.S. by a mile.
Yeah.
But now they are adding traditional stock trading for all their U.S. customers.
So I can literally just buy Bitcoin and then buy a share of Apple stock in the exact same app.
Exactly. They are evolving into a brokerage for traditional equities.
That is a massive play.
They are seamlessly blending Wall Street and Web3 into a single unified interface. It is a very smart strategic move to lock users into their ecosystem.
Keep all the money in one place.
Precisely.
And on the flip side of that, you have the traditional finance guys aggressively moving into crypto.
Yes, you do.
The CME Group, the Chicago Mercantile Exchange, is launching 24/7 crypto futures trading.
That is a highly significant shift in market mechanics.
Why is that such a big deal?
Well, traditional finance markets usually operate on strict schedules. They have opening bells, closing bells, and they take the weekends off.
Right.
But crypto never, ever sleeps.
Yeah.
It is always on.
It's always volatile.
By moving to 24/7 trading, the CME Group is officially acknowledging that the always-on nature of crypto is the new global standard.
That makes sense.
Traditional finance is being forced to adopt the habits and the plumbing of the crypto world.
It is basically like the parents starting to use the exact same slang as the teenagers.
That is one way to look at it.
It is happening whether they like it or not. And just look at the massive stablecoin numbers recently.
They are huge.
Circle has seen their USDC circulation go up by 72%. They are hitting $75.3 billion.
That is massive sustainable growth. Stablecoins are rapidly becoming a highly critical part of the global financial plumbing.
They are just incredibly useful.
They're being heavily used for fast settlement, for complex cross-border payments, for basically everything.
Right.
It is no longer just about wild speculation. It is about genuine, everyday utility.
But in this industry, it is not all smooth sailing.
Oh, definitely not.
We really
I'm
have
glad.
to talk about the legal drama that is unfolding. There is a massive lawsuit right now involving Jane Street and Terraform Labs.
This is a very stark reminder that the Wild West elements of this industry are still being heavily litigated in the courts.
Yeah, they are.
The court-appointed administrator for Terraform Labs is actually suing Jane Street.
And the central allegation there is pretty serious, right?
It is incredibly serious.
Yeah.
The primary claim is that Jane Street used non-public information to essentially front-run the Terra collapse.
Wow.
The allegations essentially that they knew it was coming and they traded against it to make a massive profit while everyday retail investors lost their shirts.
I mean, Jane Street is calling the whole thing baseless, obviously.
They are fighting it vigorously.
Mm-hmm.
But it really highlights that as these two worlds completely merge, the regulatory and legal scrutiny is going to be incredibly intense.
The days of just flying under the radar are well and truly over.
Absolutely over.
Now, speaking of things that quietly fly under the radar, we have to look at what might be the quietest takeover in the history of finance.
You mean Zelle?
Zelle. It is the ultimate sleeping giant.
It really is. Everyone always talks about Venmo or Cash App because they have that cool factor in the social feeds.
Yeah, they are much flashier.
But Zelle quietly moved $1.2 trillion across 4.2 billion transactions in 2025.
$1.2 trillion. That is just an insane amount of volume.
Massive.
And the funny thing is, it is just there. It is baked into my banking app. I use it all the time to pay friends, and I do not even think about it as a separate standalone brand.
And that frictionless experience is exactly why it is winning the war.
Right.
It is deeply embedded in 80% of all U.S. deposit accounts right now.
80%.
It has quietly become the absolute backbone of digital payments.
Yeah.
It is not flashy at all. It does not have a fun social feed with emojis, but it just works perfectly, and it is absolutely everywhere.
It is the quiet utility player that ends up winning the whole championship.
Exactly.
Now, from the quiet backbone of banking to the incredibly noisy world of betting markets,
Yes.
let us get into Kalshi and the rise of prediction markets.
This is an area I personally find incredibly interesting to monitor.
It is fascinating.
Prediction markets basically allow normal people to bet real money on real-world outcomes. Things like interest rate movements, political elections, even the weather.
And they're getting scary accurate.
They are becoming so highly accurate that the Federal Reserve is actually analyzing Kalshi data to help forecast macro variables.
The Fed is legitimately looking at gambling markets to help decide national interest rate policies.
Yes.
That is genuinely wild to me.
It makes a lot of economic sense if you think about it objectively.
cow.
Well, people are putting their actual money where their mouth is. They have skin in the game. That creates a very strong, unvarnished signal compared to a standard poll.
True. People lie to pollsters, but they do not lie with their wallets.
Exactly. But of course, this rapid growth also creates completely new problems.
Oh, the scandals. I read all about this recently. Kalshi actually caught several insider traders operating on their own platform.
They did indeed. And some of the stories are almost comical,
Right.
but legally quite serious.
Like what?
They literally had a working politician betting on their own political race.
You just cannot make that up. I am running for office, and I am putting my own money on myself to lose.
Or to win. Either way, it is highly problematic.
Totally.
And they also caught a YouTube insider who was placing large bets based on private metric information they had about specific content creators.
Wow.
Kalshi has essentially had to create its own internal police force to monitor all this activity.
It brings up such a weird legal gray area, though, does it?
It really does.
Like, is it actually insider trading if you bet on a weather event because you are a meteorologist who knows a storm is coming?
Right.
Or if you bet on a movie being a total flop because you work at the studio and you saw the terrible early edits?
That is exactly the complex debate.
Yeah.
The unique insight is exactly what prediction markets thrive on.
Yeah.
But the hard line of when does insight officially become illegal insider information?
It is very blurry.
As these markets continue to grow and scale, we're going to see a huge wave of legal and ethical questions arise that we simply do not have answers for yet.
It is a whole new frontier for the lawyers to figure out. Okay, we have definitely covered a lot of ground here.
We certainly have.
From massive private markets to AI coding minions to politicians betting on their own campaigns, it really feels like things are moving faster than they ever have before.
They absolutely are moving faster. And if we just zoom out for a quick second,
Yeah.
I think it is really helpful to frame this entire era as the acceleration decade.
The acceleration decade. I really like the sound of that.
It basically encapsulates the idea that AI rapidly compresses the time between wanting something and actually getting it.
Right.
The traditional gap between having an idea and executing that idea is shrinking to almost zero.
And that is honestly incredibly stressful for our human nervous systems to deal with.
It is exhausting.
So what is the actual answer here? Do we just try to run faster and faster to keep up with the machines?
No, I think the exact opposite is true, actually.
Okay.
The main takeaway from all of this, whether you are a startup founder, a venture investor, or just someone trying to navigate your career,
Yeah.
the way to truly survive and thrive is not to speed up. It is to build depth.
Build depth.
It's to build strong judgment and highly refined taste.
That is a really powerful way to look at it because the AI can easily do the rote work now.
Exactly.
It can write the software code. It can parse the flat files. It can fill out the complex insurance forms. But it cannot decide what is actually worth doing in the first place.
You nailed it. In a modern world where execution is incredibly cheap and almost instant, the real value shifts entirely to the human decision maker.
The strategist.
Right, to the person with the taste to know what a good product looks like and the judgment to know what actually matters to people.
Yeah.
That is exactly what connects the founders of a giant like Stripe, the investors looking at Robinhood, and even the everyday users choosing Zelle.
It is all connected.
It is ultimately about deeply understanding the flow of human behavior and making the right strategic call.
Building taste and judgment. I think that is a genuinely perfect note for us to end on.
I agree.
It has been an absolutely massive shift in the financial world lately, and honestly, the next wave will probably be even crazier. But hey, that is exactly why we are here to unpack it all.
It certainly is.
Thanks for listening to The Vocal Technologist. Have a great weekend, everyone. Maybe stay off the political prediction markets for a bit, and we will catch you on the next one.
Goodbye, everyone.
Spoken Tech for your ears.